The Ethena token price has gone up 20% since yesterday, when it fell. This is happening while the crypto market is down. Everyone is interested in the price increase, especially since the market is going through a rough patch. Let's talk about why this rose and whether it can last in this block. When Donald Trump ended the crypto summit, investors' excitement sparked a small rise in the market. The price of Ethena tokens went up along with Bitcoin, but there's more to this altcoin's price rise than meets the eye. To start, the number of trades has gone up. It's up 23% in the last 24 hours. That's $645 million right now. It shows a lot of people are buying and a lot of investors are interested. It's interesting that 2.07B, which is 39.17% of the total supply, was put on the market the day before. This caused a huge drop because the token opens made people want to sell it. To get back to the subject, CoinGlass data shows that open interest has grown to $42.3 million. It shows traders are becoming more active and opening more positions in the ENA futures contracts, advancing the price rally. Even the long/short ratio on Binance shows that investors are more interested in long, which means they are betting for a price surge. Such action can bring upward momentum and affect investor sentiments. Will Ethena sustain this rally? Many technical reasons have favored the ongoing price rally, and a few will likely continue to push the token higher. It includes the liquidation data, which hints at the uptrend creation. In the last 24 hours, $3.3 million shorts were sold. Buying pressure is formed as the short sellers rush to buy back the token. Hence, a price surge is predicted. It currently trades at 45 cents with a market value of $1.45 billion, so an uptrend can push it toward its ADH. In addition, crypto analyst Rose shows that the ENA is retesting a major support at $0.2049. As long as ENA holds this support, an uptrend will likely form, as the analyst thinks this level acted as a strong demand zone earlier. Moreover, the Ethena token price chart may form a double bottom pattern, showing that a bullish uptrend will begin. With that, the key support zone lies at 20 cents, the possible reversal zone, and the key resistance stands at 50 cents, 75 cents, and $1. A successful move past these would result in the 75 cents, $1, and $1.50 price goals per Ethena price prediction. Ethena token's strong 20% price recovery shows its position in the market. Despite the drop, the investors' trading activity stayed high, showcasing strong investor interest. The positive investor attitudes, bullish derivatives data, and short liquidation are the prime reasons behind this recovery. Interestingly, the rise will continue if the trend reversal happens at $0.2049 and tokens move towards the key resistances at 50 cents, 75 cents, and $1. With this, the ENA price can reach new highs, especially if the Bitcoin price recovers. Ethena is a synthetic dollar protocol built on Ethereum that will provide a crypto-native solution for money not reliant on traditional banking system infrastructure, alongside a globally accessible dollar-denominated savings instrument, the Internet Bond. Ethena's synthetic dollar, USDA, will provide the first censorship-resistant, scalable, and stable crypto-native solution for money achieved by delta hedging staked Ethereum collateral. USDA will be fully backed transparently on-chain and free to compose throughout DeFi. USDA peg stability is ensured through the use of delta hedging derivatives positions against protocol-held collateral. The Internet Bond will combine yield derived from staked Ethereum as well as the funding and basis spread from perpetual and futures markets to create the first on-chain crypto-native bond that can function as a dollar-denominated savings instrument for users in permitted jurisdictions. Crypto can no longer depend on traditional infrastructure for stable coins. For any functional, truly decentralized financial system to work at scale, a stable asset not reliant on legacy banking infrastructure is required for both transactional money, as well providing the core collateral for funding. Without a decentralized and stable reserve asset, both centralized and decentralized order books are inherently fragile. Centralized exchanges are in desperate need of a reliable and transparent stable asset for their order books, and DeFi faces ongoing existential risk by relying on USDC or RWAs with a centralized kill switch. Reducing the reliance on the traditional banking system for the role stablecoin infrastructure plays in the space is, in our view, the single most important issue facing crypto today. 8 billion people have no access to a dollar-denominated savings instrument. Whilst U.S. citizens have access to their own $30 trillion treasury market, individuals in the rest of the world do not have permissionless access or the ability to generate a yield on a dollar-denominated savings instrument. User demand for existing stablecoins is already provable and enormous at $130 billion plus despite their return-free risk profile. The team views a substantially equivalent product that provides a permissionless savings return as the largest market opportunity that crypto can provide for individuals all over the world, larger than either a volatile store of value or stablecoins as they currently exist. The team fundamentally believes the most important financial instrument in the real world, a dollar-denominated savings instrument, is a basic product everyone should have the ability to access without permission. Existential importance to the space. Stablecoins are the single most important instrument in crypto. All major trading pairs across spot and futures markets in centralized and decentralized venues are denominated in stablecoin pairs with greater than 90% of order book trades and greater than 70% of on-chain settlements being stablecoin denominated. Stablecoins settled greater than $12 trillion on-chain this year, constitute 2 out of the 5 of the largest assets in the space, greater than 40% of TVL and DeFi, and are by far the most utilized assets across decentralized money markets. Stablecoins are not only the foundation of the entire industry, but are also arguably the only asset to have found true product market fit globally with more than 100 M users, 2, the largest addressable market, and 3, the greatest potential for revenue generation. Centralized challenges. Centralized stablecoins such as USDC or USDT provide stability and capital efficiency, but they introduce unhedgeable custodial risk with bond collateral in regulated bank accounts which are prone to censorship. A critical reliance upon the existing banking infrastructure and country-specific evolving regulations. A return-free risk for the user as the issuer internalizes the yield whilst exporting the risk of depeg to users. Decentralized fragility and lack of scale. Decentralized stablecoins have historically experienced a number of issues relating to scalability, mechanism design, and a lack of embedded yield. Over-collateralized stablecoins have historically experienced issues scaling as their growth was inexorably tied to the on-chain growth and leverage demand for Ethereum. Lately, some stablecoins have resorted to onboarding treasuries in an effort to improve scalability at the cost of censorship resistance. Algorithmic stablecoins have faced challenges with their mechanism design, which were found to be inherently fragile and unstable. They do not view these designs as sustainably scalable. Prior delta-neutral synthetic dollars struggled to scale due to a critical reliance on decentralized trading venues that lack sufficient liquidity. The solution is now possible. How can they provide a trust-minimized, scalable, and stable asset which is both unreliant on the banking system and systemically creates economic protocol-level returns that can be passed to ecosystem participants? Through the use of derivatives on staked Ethereum collateral on deep and liquid centralized venues, USD aims to directly address both the scalability stablecoin trilemma that previous decentralized stablecoins designs have encountered, as well as the custodial risk deficiencies of centralized stablecoins. Solution: the Internet Bond. A crypto-native synthetic dollar utilizing Ethereum, on-chain custody, and centralized liquidity venues. Ethena Labs believes a delta-neutral synthetic dollar that holds collateral outside the banking system and that can access centralized liquidity addresses the challenges of existing stablecoin designs. USDA is enabled by Ethena Labs via hedging the delta of spot assets backing the token during minting. As a result, USDA provides the following benefits. Scalability is achieved by utilizing derivatives, which allows for USDA to scale with capital efficiency. Since the staked ETH collateral can be perfectly hedged with a short position of equivalent notional, the synthetic dollar only requires 1:1 collateralization. 2. Stability is provided through hedges executed against the transferred assets immediately on issuance that ensures the synthetic USD value of USD backing in all market conditions. 3. Censorship resistance by separating backing from the banking system and storing trustless backing assets outside of centralized liquidity venues and on-chain, transparent, 24/7 auditable, programmatic custody account solutions.